Hey guys, welcome back. In this next video, we're going to be going over some of the rules for your psychology, and we're going to add some in-depth rules for you to help you furthermore fight those four main trading fears. Which, just to recap, number one was being wrong. The second fear was the fear of losing money. The third fear was FOMO, which is the fear of missing out. And fourth was the fear of leaving money on the table. So our goal with these rules is to help you see and think clearly without emotion. It's very simple like that. And as we go through life, the reason why we're focusing on these rules is because as you go through life, we are given rules at every stage to abide by in order to be successful. Like, if you think about it, you go to school and they tell you where to sit and when to talk and how to be successful taking a test, and then you graduate and then you go to college, and again they teach you where to go, when to be there. You have a little bit more autonomy, but at the same time you're still going through a set process. After school, after college, you go to a job and they tell you again when to be there, where to sit, what to do. So all throughout life, we're given all these examples and all these rules of how to be successful. But there's no rules in trading. You can do whatever you want. There's absolute freedom with it. And the fact is, people don't thrive in that environment. So what traders fail to learn is that they need to follow a set of personalized rules in order to succeed. That's just human nature, and society is set up for rules. So the first rule is to trade what you see and not what you think. Your trading may be subconsciously manipulated by your perceptions, feelings, intuitions, and beliefs about money, about yourself, about success, about a multitude of different things. And the problem with that is that perceptions and feelings and intuitions are all subjective. Only you feel those feelings, meaning that you're not able to see all possibilities when you're caught within yourself. You can't see other people's point of views because you're so swayed by your perceptions and your feelings and your thoughts. Your subconscious bias will always sway you in one particular way. So for trading, the way that relates is that it might cause you to hold bad trades or to close good trades early because of your initial thoughts or feelings. So you could be in a situation where you are caught in a buy, but a sell with your strategy, a sell is actually setting up, but you're going to hold the buy because your previous bias has subconsciously manipulated to think that the market is going to go up. So you have to trade what you see and not what you think and feel, and this will help you follow your strategy. And as a trader, you want to strive to become completely objective. And in trading, this means approaching the market with the attitude that anything could happen at any time for any reason. With this mindset, you'll be able to view the market from above rather than fighting it from within inside your mind. So the second rule is that the amount of money made or lost on a trade does not define the quality of your trade. And what that means is that the actual dollar amount on a trade is only important in relation to your overall account. So this is supposed to get you to start thinking in terms of percentages, because it's the percent gain that matters in the long run. So if someone makes $1,000 on a trade, but they have $1 million account, I mean, that's a really small percentage trade. But if that same $1,000 is made on a 10 grand account, well, that's huge. That's a 10% trade. That's a fantastic day of trading. So by focusing on money, you're actually focusing on the wrong part of the hierarchy. You're focusing on step 4 of the hierarchy, which is the money part. But by focusing on the percentage gained, you're actually focusing on the mindset and the skill set that it takes to trade. So the true measure of a great position is the amount gained compared to the amount risked. So if you risk $100 to get $500, that's a great trade. But if you risk $1,000 to get $500, I mean, that's not a good trade. It's because it's the same amount of money, but it's a vastly different scenario in which you entered that trade and which you earned that money. The third important thing to know is that good trades can lose and bad trades can win. It seems counterintuitive, but what I mean by that is that profit in the market can happen at random, regardless of your strategy, your psychology, your mindset, the amount of risk you use, your experience in the market. It can happen regardless of any of that, because anybody off the street could technically open an account, open up a particular pair, and press buy or sell. And they might get profit from that. But is that a good trade? If you make the profit, is that a good trade? On the other hand of that, you can have a professional trader who has been analyzing the market for years and finds a position that has worked for them time and time again. It follows all of his or her rules and it fits within their strategy, but they lose the trade. So you can have a rookie who enters not knowing anything and make money, and a professional who enters a trade based off of his rules that loses. Which trade is better? Well, it's the one where the professional trader has followed his rules and his strategy. Because here's how we define a good trade. Any trade that is executed according to your rules and your strategies, that is made without emotional interference, is a good trade, regardless of the outcome. Because, like I've said earlier and many times, it's about the probabilities. We can't win every trade, and that's just how it goes. But if you follow your rules and strategies and you're not emotionally attached to the trade, it's a good trade. You can feel good about that. Even if it loses, it happens. And then a bad trade is defined as any trade that isn't a good trade. If you don't follow your rules and you're emotional when you enter when you enter the trade, then it's a bad trade, regardless of if you make money on it or not. And the fourth rule is to never waste a loss. Record everything. And people hate being wrong, and we've discussed this in the last video. Because people hate being wrong, and no one comes into a situation and thinks, I would love to be wrong about everything today. In trading, you're going to be wrong a lot, though, especially at the beginning as you're kind of tweaking things and fine-tuning things and finding your own way kind of through the market and how you see it personally. But along those ways, or along that path, you have to stop and look at why you've lost trades and why certain things are happening and what you can do to make them better. So win or lose, you have to keep gathering data on your trading. Without the numbers, you won't know exactly where to improve. You might know that you need to improve, but you might not know exactly where. You might be closing out of trades too early. You might be entering too late. You might be trading counter trend and you don't even know it. So there's a lot of things that can go into why your trading is going well and into why your trading is going poorly. But either way, we need to record the data and figure out why things are happening. So again, a winning trade doesn't always mean that you know what's going on. And this is really the gambler's theory comes in here, because the way the market is set up, it's set up for you to win a very small amount of trades. And really, this kind of goes back to how casinos run their business. So when you go to a casino, you're going to lose money most of the time. But the casino has to make it seem like there's just enough chance that you're going to win in order to keep you coming back. Because if you just went to the casino and lost, kept losing over and over again, well, casinos, they know that you're not going to come back. It's just going to seem like a sham. So at a small rate, the casino plays the game with you, and they'll throw you nickels while you give them quarters. That's just how it works. And the markets are the same way. So if the big banks that control the market never let retail traders like you and I win, then they would have no one to trade with. They would have no one whose money that they could take. So even if you win, you could still be part of the market manipulation strategy. They're just trying to keep you in the game because the euphoria of winning outweighs the pain of losing for a vast majority of people. This is why casinos are still in business, and this is why trading is still a thing for retail traders. So now that we've gone over the 4 rules, which, just to recap, number 1 is trade what you see, not what you think. Number 2 is that the dollar amount that you make on a trade doesn't define a good trade. 3, good trades can lose and bad trades can win. And the 4th rule is to never waste a loss, is to record everything and gain gratitude for those losses. And the main goal of all these rules is to just bring you out of your subjective self with all your feelings and your emotions and your personal thoughts, and bring you into an objective mindset that is in balance with the rest of the market so that you can view it with a clean mind. And these rules accomplish that by bringing your focus really away from the money and away from the things that will happen to you early on, or that will happen to you later on. And they'll take you into where you need to be, into the learning and improvement mode, where you're focusing on those things instead of the money that you're going to make. Because the only way you can get to the step of making money is by learning these things and by controlling your emotions. That's what good traders do. So how do you improve from your trades? You just learn from them. And these are going to help you neutralize your fear of being wrong and your fear of losing money. And you'll begin to see everything as an opportunity, not just wins, but losses as well. And, if you view losses in a positive light, then you can't have any emotional dissonance about losing a trade. And this is going to bring you into a point of balance and objectivity, and you're going to make a killer trader.